Imagine investing in the next big thing. What if you could spot the next Amazon, Tesla, or Apple before they skyrocketed? Growth investing is all about finding those opportunities, the companies that are poised to disrupt industries and multiply in value. But here's the catch. With big potential rewards come big risks. Are you ready to learn how to ride this roller coaster and potentially turn a small investment into something life-changing? Stay tuned, because by the end of this video, you'll have the knowledge to start your own growth investing journey. This is the third video in the series about different ways to invest in stocks. If you haven't seen the others yet, I'll leave the links in the description so you can watch them later. So, what exactly is growth investing? At its core, growth investing is about identifying companies that are expected to grow at an above-average rate compared to other companies in the market. These are companies that reinvest their earnings into expansion, innovation, and capturing more market share, often sacrificing short-term profits for long-term gains. Growth investors look for businesses with strong revenue growth, expanding customer bases, and innovative products or services. These companies might not pay dividends because they're focused on scaling up and maximizing their future potential. The goal? To invest early and watch your investment grow exponentially as the company thrives. But not all growth stories have a happy ending. While some companies soar, others stumble and fall. How can you tell the difference? Stick around to find out the key factors you need to watch for to separate the winners from the losers. But first, let's go through the pros and cons about growth investing. Let's start with the pros. High potential for capital appreciation. Growth stocks offer the possibility of substantial returns. If you invest in a company early in its growth phase and it succeeds, the value of your investment can multiply many times over. Exposure to innovative industries. Growth companies often operate in dynamic, fast-growing sectors like technology, healthcare, or renewable energy. By investing in these companies, you're placing your bets on the future and the next big innovations. Compounding effect over time. As growth companies reinvest their earnings into further expansion, the value of these companies can compound over time, leading to exponential growth in your investment. Now, let's check the cons. High volatility. Growth stocks are often more volatile than other types of stocks. Their prices can swing dramatically, especially if the company doesn't meet its growth expectations or if the market sentiment shifts. High valuations. Growth stocks usually have high price-to-earnings ratios, meaning they are expensive relative to their current earnings. This makes them more susceptible to sharp declines if the company's growth slows down or if the broader market corrects. No dividends. Many growth companies reinvest all their earnings back into the business, so they don't pay dividends. This means that if the stock price doesn't rise, you won't receive any income from your investment. Greater risk during market downturns. In a market downturn, growth stocks are typically hit harder than more stable, dividend-paying stocks. Investors often move their money to safer assets during these times, causing growth stocks to drop in value. Let's get to the nuts and bolts. How do you actually screen for growth stocks? First, look for companies with strong revenue growth. A consistent year-over-year increase in revenue is a good sign that the company is expanding. Next, check out the company's earnings reports. Are profits increasing? Even if a company isn't currently profitable, is it on track to be? Look for positive trends in earnings and cash flow. Also, consider the industry the company operates in. Is it a growing sector with lots of potential? Companies in cutting-edge fields like technology, renewable energy, or healthcare often have higher growth prospects. Finally, keep an eye on the company's management team. Are they experienced? Do they have a track record of delivering on their promises? Strong leadership can make all the difference in a company's growth trajectory. To wrap it all up, growth investing is about finding and investing in companies that have the potential to grow significantly over time. While the risks can be high, the rewards can be even higher if you choose the right stocks. Remember to look for strong revenue growth, positive earnings trends, and a growing industry. And most importantly, don't forget to research the management team behind the company. With the right approach, growth investing can be a powerful way to build wealth over the long term. So, are you ready to start planting the seeds of your future? Take a look at this next screen where I'll be leaving other videos with great investment content you can use to grow your wealth substantially. Check it out. See you in the next video.